Alright guys, we're gonna switch the style up. I hope you're ready. I'm excited to do this video. We got a lot to talk about. I got my co-host Jax with me. Jax said what's up. Jax is chilling. He's happy to be here. But we're gonna talk about what happens when the stock market goes down. And this is gonna be another video. It's probably gonna alarm some of you options alarmists who get mad when here, Jax, you're gonna co-host this with me. You know, the option alarmists who get mad at some of these, you know, beginner type videos and everything. But and what I mean by that, we're going to talk about something for beginners. I'm going to go over some, again, crazy options plays, but talk about the basics of what, you know, how you could use options to play a decline in the stock market, use a little bit amount of money to profit when the market's in decline, and how this operates. And I'm just going to, you know, really talk about what I would do, because people have asked me how I would play a market crash. So let's go to the screen. You know, so I have Amazon up here. There's me, you guys. You can see my hair. I got to move out the way, but this is the option chain. You guys see there's Amazon. I don't know, tell me what you guys think about this view too. It's a really, really big option chain. I gotta go to my computer. I have something way out the money, but let's start with the basics. So you guys have heard me talk about this whole option chain thing. I don't know if I should just zoom in, but this is how the option chain looks, right? You got a bunch of numbers in the middle, and this is called a strike price. So this is what you're agreeing upon. So again, these are all contracts. You're making an agreement with someone. So how we plan to make money with stocks going down is we're going to buy puts. So when you buy puts, you're essentially expressing you think the stock market's going to go down. So usually on an option chain, your puts are going to be on the right side over here. And what you're essentially getting someone to do is agree to buy a stock from you. So you have to think how you can make money off of that. If you get somebody to sign a piece of paper saying, I agree to buy a house from you for $100,000, and the real estate market crashes and that house is now worth $20,000, you could go buy it for $20,000 and sell it to them for $100,000 because they have to. That's essentially what's going on here. So yeah, I'm gonna try to I think I'm just gonna zoom in. I don't know how this looks. So to your right, that's the put. So these are crazy puts. You know, with the thing you got to notice about puts and options in general, you select the time frame. Those are those dates up there. I don't know if I could, this is the most I could zoom in. Wow. So you see those dates up there. You select your date, the time, and then a price to agree upon. So in this case, the one that's highlighted, we're getting someone to agree to by November 16th in the next month, agree to buy 100 shares of Amazon from us for $15.50, and Amazon's trading right now like 1,800, I believe, around there. So or 1770, I think. So you're making that deal with someone saying, hey, I'll buy Amazon $200 cheaper than where it's at. It makes sense why they would do it, because they would agree to buy Amazon cheaper, and you're expecting it to go down lower. So now the price, that's what you see on the ask, that's going to be the 1920. So you times that by $100, you're going to be spending like 1920, or is that 1970? Am I blind? I think 1970. I'm blind. So it'd be $1,970. So pretty much you would need to be making $1,970 to make your money back by the end of expiration. So that's going to be your break even. And these are the intricacies of options. So there's a lot more we could go down explaining this. I don't want to spend too much time on that. Is that important? Yes, it's one of the most important parts of options, you know. But the whole idea of this video, and what I want you guys to understand, is how you're simply, you know, this is the go-to plan when it comes time, okay? We think market's going to go down. We think asset prices are going to drop. What are we going to do? We're going to use puts on the stock market. That's what a lot of people do and have done notoriously. So if you're thinking, you know, how do I set up my strategy to play a market downturn, you know, start thinking about options. And if you've never done that or traded those before, that could be a good look. So if you put that into perspective, it could end up being something that I think a lot of people miss out. And now understanding what types, and there's two ways to go about it. You could go in the money, out of the money, near the money. For me, and this answers the question of what people have asked me, you know, how am I going to play a market crash? You know, essentially, there's many ways to answer this question, because there's a market crash, a market correction, a bear market, and every single one of those is going to be different. You know, a quick, immediate crash, something, and again, to the scale of, we're talking crash, China goes down, America goes down, there's huge problems like '08. I want out of the money. I'm going to aim for these 1550 puts, stuff crazy out of the money on stuff that's moved a very, very large amount over the last couple years. So I want the tech stuff with high PEs, stuff overinflated, and those are what I'm going to buy crazy out of the money puts on. So that's what I would do if it was a temporary correction. I'm going to probably go near the money puts and try to, you know, play money on the downside, scalp, and then even start trying to buy some stuff on the way down. And then if it is a bear market where we kind of start changing into this market where now things slow down in the sense that it's, you know, we're just not going up, but it's not really sharp declines and volatility, but consistent and slow down, that would be hard to say. I'd probably want to honestly start selling premium in that situation. So that's pretty much the basics of how to make money. So with, you know, with the stock market goes down, what we do is we buy puts. So again, as an example, like I said with the house, it's the same thing. I've done this with stocks, and now this is what people do when they think something's going to happen. And, you know, now the key to this is, you know, beyond understanding the, you know, how the contract is going to get value, how you're going to make money, and what you need to do, it's understanding really where you think the stock is going to be able to go, or the reasoning that's making something go down. You know, because when I'm saying, you know, this is how we make money when stock's going down, I'm thinking of situations, very big situations, stuff even like VRX, if you guys are familiar, or like lumber liquidators. These companies had huge moves to the downside, and it was off of, you know, one had like accounting fraud, VRX, lumber liquidators had an issue with like China and health concerns with their product, and it really hurt the sales in the company. You know, based on making the right play in the option, you know, getting somebody to agree to buy a stock from you at a high price, and then that stock changes value, you have a lot of room to make money. And now it all depends on what price you're getting it at. Obviously, these contracts here, like on Amazon, are $1,500 for like a big $200 move. But then again, earnings is coming up, so you would be surprised what could happen here. But, you know, there's many stocks that have this opportunity. And now again, in the event the market starts going down, these puts are going to, you know, you can make a pretty good amount of money. On the reverse side of that, you've got to be careful, because when the markets are going down, these puts get really, really expensive. And what happens for a lot of new people, they end up buying them, but they're spending so much money because the implied volatility, the market's already been dropping, the option's been going up a lot, they really end up getting screwed over. So you have to be careful with that when you guys are trading, because that's probably the biggest issue you're going to run into now when it comes into making money with puts. It is getting them at the right time. And, you know, really what I see is people pay too much, because now if you pay too much, well, that's going to be a problem, because then now it's saying by expiration, I guess we're talking break even. Essentially, you're saying, you know, 1530 or 1550, and I'm paying $1,900. You need the stock to drop $19 from 1550. So that's like what, 31? You know, so you need the stock to go to 1531 just to be able to break even. So by November 18th, if you bought this contract right here, right now, and you're not at 1531 Amazon, you lost money. But anything after 1531, you would make, you know, dollar for dollar on, meaning if it went to 1530, you would make $100 profit. So you would have, the contract would be worth probably $2,000, but remember, you paid $1,900 for it. So that's pretty much the basics of it. And again, oh, well, no, I'm not finished. What am I saying? I was going to show you guys with this contract, because I think this is a good example. I have it right up here. Here's the price chart of this. If we look at it, even in the last coming days, I think, I don't know what date that is. What is that, August 3rd? I don't know if you guys see that. Okay, I'm really just going to use a computer next time. All these theatrics are just stupid. I don't know if you guys agree, but it's at $1,500 now. It was at $500, you know, a few days ago. It's dropped too. You know, at one point it hit $4,000, down to $1,200 or just below that. Now it's at $1,400. But you could have got this at one point for $500, maybe even cheaper a couple days before. but you see how the contract has picked up in price, how it's moved, and you know, literally what time has done with this contract in general. So you guys, if you buy it at the right or wrong time, depending on the reason why you're buying it, that could change a lot of things for you coming into, you know, earnings play or anything. But in general, if you're trying to say, hey, I think it'll go down, if you buy the contract at the wrong time, you could still be right, but still lose money in the sense that you paid so much, you are needing such a big move for it to actually become profitable for you. So that's pretty much the gist of it. I'll leave it there. If you guys have questions, let me know. Again, this is pretty basic. This is basic on puts and calls. If you have questions, let me know. If you guys want me to make a video on it, again, you could just go even Google puts and calls, Investopedia, great source. But this is my go-to plan. Again, short everything with high PE ratios, or get puts on everything with high PE ratios and these tech stuff that's moved. And it's really about identifying the situation that we're in. So love you guys. Subscribe, drop a like, comment. I love y'all. Let me know what you think about these theatrics. Peace out.